Why does losing $100 hurt so much more than winning $100 feels good? Welcome to the most powerful psychological force in investing. It's a force that dictates your bank account, your retirement, and even your daily happiness. It's called loss aversion. Today, we're going to dismantle this silent killer of wealth and learn how to master the psychology of money. Loss aversion is a cornerstone of behavioral economics. It explains why our brains are hardwired to protect what we have, even at the cost of what we could gain. To understand it, we have to look back to 1979, when two psychologists changed everything we thought we knew about risk. Daniel Kahneman and Amos Tversky realized that human beings are not the rational econ actors that traditional finance assumed. They introduced prospect theory, proving that our response to financial changes is completely asymmetric. This curve represents the asymmetric value we place on gains versus losses. Notice how the pain side drops much faster than the pleasure side rises. This is the mathematical proof of our bias. Their research demonstrated that losses are roughly twice as powerful as gains. This isn't just a feeling, it's a measurable coefficient. Statistically, the pain of losing $100 is only offset by the pleasure of gaining at least $200. Think about a 50-50 coin toss. If you could lose $100 on heads, how much would you need to win on tails to take the bet? For most people, anything less than $200 doesn't feel worth the risk. The fear of that $100 loss is simply too heavy. But why? Why are we built this way? To find out, we have to go back thousands of years to our evolutionary roots. In the wild, survival was a game of margins. Failing to find extra food meant hunger, but losing your existing shelter or fire meant certain death. Our brains are still stuck in a scarcity mindset. In a world of limited resources, protecting what you already had was the only way to ensure your family's future. Survival wasn't about winning, it was about not losing. Our ancestors survived by prioritizing the avoidance of threats over the pursuit of opportunities. We are the descendants of the most cautious hunters. Kahneman and Tversky illustrated this perfectly with the famous disease problem study. It showed how framing changes everything. When the choice was framed in terms of lives saved, people were risk-averse. They chose the certain outcome of saving 200 lives. But when the exact same outcome was framed as 400 deaths, people became risk-seeking, gambling to avoid the certain loss of life. Now let's bring this into the world of investing. This biological hardwiring creates several distinct, often destructive behaviors. First is the disposition effect. This is the tendency to sell your winning stocks too early to lock in a gain, while at the same time holding on to losing stocks for far too long. We hate to admit we were wrong and realize that painful loss. Closely tied to this is the sunk cost fallacy. We feel that because we've already invested time or money into a loser, we must keep going. But in the market, the money you've already lost is gone. Your only concern should be the future. Psychologists call this get-even-itis. We hold on in the desperate hope that the price will return to where we bought it, just so we don't have to feel the pain. Then there's panic selling. When the market drops, that 2-to-1 pain ratio kicks in. To stop the perceived hemorrhaging, we exit at the bottom. By selling out of fear, we effectively lock in a temporary loss and turn it into a permanent financial scar, missing the recovery that follows. Loss aversion also leads to overly conservative asset allocation. The fear of minor portfolio dips drives people to hoard cash. While this provides short-term comfort, it results in failing to keep pace with inflation. You're losing money anyway, just more slowly. Financial research firm Dalbar consistently finds a massive behavioral gap. In 2022, while the market lost 18%, the average investor lost 21%. That 3% difference is almost entirely due to loss-averse actions like panic selling and poor market timing. The biggest cost of loss aversion isn't the money you lose, it's the opportunity you miss. Every dollar kept in safe, stagnant cash is a dollar that isn't compounding in the world's most productive companies. And then there is myopic loss aversion. This occurs when we check our portfolios too frequently. It turns the market into a source of constant stress. On a daily basis, the stock market is basically a coin flip. It's positive about 55% of the time. Every check is a chance to feel pain. But over a 1-year period, the market is positive roughly 75% of the time. Over 10 years, it's almost certain. The less you look, the more you win. So how do we fix it? We can't turn off our biology, but we can manage it. Here are the strategies of the world's best investors. First, the overnight test. Imagine you went to sleep and your losing stock was sold, replaced by its current value in cash. If you woke up and were offered the choice to either keep the cash or buy that same stock back, what would you do? If you wouldn't buy it now, sell it. Second, reduce your observation frequency. Kahneman himself says that checking performance once a quarter is plenty, once a year is even better. Third, use rule-based investing. Set your exit criteria before you even buy the asset. By making the decision early, you bypass the emotional panic. Systematic rebalancing forces you to do the rational thing. Sell assets that have grown and buy assets that have fallen automatically. Fourth, use goal-based planning. Don't look at one big number. Segment your money into buckets for specific needs. The safety of an emergency fund provides the psychological buffer you need to tolerate the necessary volatility of long-term growth. Finally, focus on process, not outcome. Evaluate your decisions based on whether the logic used at the time was sound, not just the short-term price. Mastering loss aversion is about building psychological resilience. It's about accepting that red days are a necessary part of a green decade. You are training your brain to think in years, not hours. The best investors aren't fearless. They have simply built systems that protect them from their own biology. They have mastered their temperament. Remember, investing is 10% math and 90% temperament. If you can master your mind, you've already won most of the battle. If you want to continue this journey into the psychology of wealth, subscribe to the channel and join our community of rational investors. Leave a like if you found this deep dive valuable. I'm Michael, and I'll see you in the next one. Thank you for watching.